Welcome to K.S.Rangasamy College of Technology. I am Sabrish, Assistant Professor, Department of Management Studies. In this video, we will be discussing about the topic of cost of capital. First, cost of capital dividend decision. In this unit, we are discussing about these topics like concept of cost of capital, components of cost of capital, computing specific and overall cost of capital. That is on debentures, equity, preference shares, factors affecting WACC, computation of WACC, from forms of dividends, determinants of dividend decision, theories of dividend, Walter model and Gordon model. First, meaning of cost of capital. Cost of capital is the rate of return the firm expects to earn from its investment in order to increase the value of the firm in the marketplace. A cost of capital is minimum required rate of return which firms require a condition of undertaking the investment. The cost of capital is minimum required rate of earnings, that rate of capital expenditure. So there is a difference between rate of earnings and rate of capital expenditure. Next one, definition of cost of capital. Cost of capital is the minimum required rate of return which a firm requires condition of undertaking investment for undertaking an investment. For Solomon, the cost of capital is the minimum required rate of return earnings and cutoff rate of expenditure. Next topic is components of cost of capital. In components of cost of capital, we have four types. First one is cost of debt, second one is cost of preference share, third one is cost of equity share, fourth one is cost of retained earnings. First one is cost of debt. Debt means issued at par, premium or discount. Par value means as usual value of the share issued by the company. Premium means that value should be added and it should be issued to the shareholders. Discount rate means if the shareholder is in a underrated price value, that share should be issued to the shareholders at the discount. It may be perpetual or redeemable shares. A bond is a long-term debt instrument or securities. Bond issued by the government do not have any risk of default because it honors the obligation of bond. The cost of components of cost of capital, cost of debt, it includes the perpetual or irredeemable debt, cost of non-perpetual or redeemable debt, cost of debt issued on redeemable conditions. Fourth one is cost of cancelled debt. Then meaning of preference shares. The preference share capital is a dividend expected by its shareholders. It means the computation of cost of preference capital. Then second one is an cost of preference share capital. A fixed rate of dividend is paid to the preference shareholders at regular intervals. It's not paid to them, then its effects of fund raising capacity of the firm. KP equal to dividend divided by a proportionality. That is a formula for the cost of preference share capital. Then third one is cost of ordinary or equity share or common stock. The commutation of the cost of equity capital is difficult. It's task to maintain the stock in that same price. Some people may argue, as an observed in the case of a preference share, that the equity share capital do not involve any cost. The cost of equity share may be defined as the minimum rate of return that the company must earn on that portion of the total capital employed in the financed by the equity capital. Fourth one is a cost of retained earnings. The cost of retained earnings means share in which determines the market price of the share. As bond is long-term debt instrument or securities. The bond are issued by the government and the public sector of companies. Bond issued by the government do not have any risk default, but it is honor the obligation of its bond. Next one is an computation of specific and overall cost of capital. we have a method of computation of cost of capital. First one is a specific source of finance, then second one is a weighted average cost of capital, that is in WACC. So in specific source of finance, we have the cost of debt, cost of preference share capital, cost of equity share capital, and then retained earnings. First one, the cost of debt means the rate of interest payable to the debenture holders. The cost of debt means it is the form of interest payable to that particular debenture holders. Then second one is an cost of preference shares. The preference shareholders get the dividend for that equity shares. They have they don't paid a dividend at the fixed rate. They just get the dividend as the company earn the profit as that particular particular year. They are not paid the dividend at the fixed rate for the shareholders. Shareholders invest money in hope that they have dividend, and the firm earn minimum rate of return to keep market price for the shareholder staple. Then third one is an cost of equity shares. The cost of equity share. Then fourth one is an retained earnings. The cost of retained earnings means the opportunity cost of a dividend forgone by the shareholders. This is an retained earnings. Then next topic is an factors affecting WACC. First one is an economic conditions. The economic conditions means when in a situation when the bank can easily give loans at a lower rate of interest to increase the stability of the company, debt will decrease. The cost of equity will increase. This is the concept of economic condition. If it is not just limited to the bank, it can say that any economic condition can be applicable for the same. Second one is an capital structure. Debt equity ratio will be always affect the cost of capital, because if the debt is greater than the share capital, the cost of capital would become more. But if the stock capital exceeds the debt, the cost of equity has to be paid. Third one is a dividend policy. Every company has its dividend policy. The amount of total earnings of the company interest to be paid as a dividend. Fourth one is an receiving new funds. If any business requires a certain amount of immediately for certain purpose, then the company will need paying a real high rate of interest, and with the risk of financial institution will also increase. The company is bound to follow the new rate of cost of capital that might affect business cost of capital rate. Fifth one is an financial and investment decision. When a business gets new share capital, they have to maintain cost of fund provided for using their capital. If they find too risky, then both of creditors and the shareholders will receive high rewards. Sixth one is an income tax rates. Any business after earning money, they deduct interest charges, tax charges. Therefore, high tax rates will affect the cost of capital and vice versa. Fifth one is an breakpoints of marginal cost of capital. It means equal to amount of money at which source of cost of capital changes or proportion of new charge will be raised from the sources. That is an breakpoints of marginal cost of capital. Next one, computation of WACC. The computation of WACC means average cost of capital measures average cost of company paying finance to the capital assets. Capital cost can includes long-term liabilities like preferred and common stock and bonds that company pay to the shareholders and the capital investors. And how to calculate WACC? The step one is determine the equity and debt market values. It means this value represent the first and second term in the formulas that addition signs may both debts and equities are necessary for understanding cost, and company covers to continuous generating the profits. So second one is an calculate actual cost of debt and equity. It means to find the actual cost of capital debts and equity to represent E and D in the VAC formula. That is an E refers to the equity market value, D refers to the debt market value. It means to determine cost of capital, company typically evaluate asset and liabilities to take actual cost and covering capital debts. Third step is combine the debt equity and equity market value. Once you know the market value and actual cost, both the cost of capital and capital debt and equity, combined the value to get the value of V variable. V means the sum of equity and debt market values. Then fourth step is to find the current corporate tax rate. It means to find the tax rate that applies to your company by the government, depending to exemptions, deductions with the withholdings to exact rate of the company pay in the tax paid for our companies. Fifth step is applying the formula. When you have the necessary values to apply the formula to calculate the WACC, then the result can help to evaluate the profitability and your company ability to cover the cost of funding business operations. Then fifth one is next topic is form of dividend. In the form of dividend we have the 6 steps or 6 methods. The first one is a cash dividend. The cash dividend means it's a most common form. The shareholders receive the cash from each share. There is a cash dividend. Then second one is a bonus share. A bonus share means also called as a stock dividend. A company always wishes to keep its investors happy. They have issued the share in a bonus for the instead of dividend. Then third one is a share repurchase. Share repurchase occurs when a company buys back its own shares from the markets and reduce the number of shares in outstanding. Then fourth one is an property dividend. The company makes the payment in form of asset under the property dividend. Fifth one is a scrip dividend. It is a promissory note that pay shareholders later. The form of dividend is used when the company does not have the sufficient incomes. Then next topic is determinants of dividend decision. First one is available of fund. In the business isn't require of fund, then retained earnings could be a good source since it saves the fluctuation and cost, and further the control will not in case of further issue of share capital. Second one is cost of capital. Financing requirement can be through the debt, then it should be preferred to distribute more dividend, but if the financing is to be done through a fresh issue of equity share in the business. Third one is capital structure, and optimum debt equity ratio should be also under consideration of the dividend decision. Fourth one is stock price. Stock price here means market price of the shares. Generally higher dividend increase value of shares and low dividend increase age. Fifth one is an investment opportunities in hand. It means dividend decision is also affected if there are investment opportunities in hand. The company may prefer to retain more from the earnings. Sixth one is an interest rate of return, internal rate of return. Internal rate of return is more cost retained earnings. It's better to distribute the earnings as much as possible in the organization. Seventh one is tender of industries. If the internal rate of return is more than the cost of retained earnings, it's better to distribute the earnings as much as possible. Then expectation of shareholders. It means the shareholders can be categorized into two types. The first one is eighth one is expectations of shareholders. The shareholders can categorize into two categories. The first one is investor for regular income. Second one is investor who for contributing for the growth. The ninth one is an legal constraints in the section 1 to 3. Out of the profit, the company arrived after providing the depreciation in accordance with the provision of section 123 subsection 2. Then 10th one is an tax action as per the section 115 of the Income Tax Act 1961. Dividend is the subject to distribution of hands of the company under the existing provision in the companies in the Income Tax Act 1961. Then next topic is theories of dividend. First one is an Walter model, second one is an Gordon model. Walter model is an next topic is an theories of dividend policy. First one is an Walter model, second one is an Gordon model. Walter model developed for relevant concept of dividend model and strongly supports that the dividend policy of a firm almost always affects the value of the firm. The Walter model formula is D plus R divided by E minus D. This is the formula for Walter model. Then second one is an Gordon model. It's developed by the Myron J. Gordon in the year of 1979, suggested relevance to the dividend decision for valuation of firm. This model is also called as an dividend capitalization models. According to this model, dividend policy of a firm that affects values, and it is based on the following assumptions, that is a firms in all equity firm, that is retained earnings represent only the source of firm financing. In investing programs, the rate of returns from the firm's investment is a constant. Then the firms can perpetual alive corporate tax does not exceed the retained ratio is a constant. Thank you.